Hey guys, Alex here from TWP Club. Hope you're well today. Just wanted to walk you through our presentation, Diversification of Tenancies, and it seems quite straightforward, quite simple, but a lot of people get this wrong. So what we're looking at here is many rents from one property is greater than one rent from one tenant. So we've got this lucky investor in the middle here. He's got some income coming through from his co-living property, dual key, small commercial property, and also dual occupancy over here. So we're looking at multiple sources of revenue to dilute that risk as much as possible. So when we look at that, and it might seem like a bit of a silly comparison here, but if you had the option to buy the Harbour Bridge or buy 100 apartments, obviously this property over here, a lot more appealing. It's got a huge price to it. It's internationally recognized. It's like a trophy style asset versus 100 little hardworking worker bees over here. These 100 apartments over here, $1 million each is $100 million. So let's say they both cost exactly the same. This over here would be a far better opportunity for you because you've got multiple sources of revenue. You've got multiple small properties there that you can carve up and you can sell if you need to as well. This here, selling in the future, is very difficult because it's a single, very large asset that's a very unique sort of proposition, but really drives home the point here. A lot of investors do get stuck looking at the really good looking, attractive property, but they're really, their focus should be on the returns from that property. So when you look at this, a traditional style landlord has got single source of income from their property. 100% of the rental comes from the single property tenancy agreement. You've got co-living and dual keys. You've got multiple leases across the property, multiple tenants paying your income for you. Let's say you've got 5 different tenants under the one roof. You lose one of those tenants, you lose 20% of your income. You have up to 9 rooms for the more co-living style property where you lose one tenant, it's 11% of your revenue. So it's pretty good in that respect. The different types of property that's available for this style of strategy is storage, low entry cost, low maintenance fee, which is fantastic. And they do return quite well. You've got co-living, you've got multiple people living under the one roof, sharing a kitchen, sharing laundry. They do have shared facilities in there. And then you've got the dual occupancy, which is traditionally the 3-bedroom plus a 2-bedroom, and they're separate tenancies. Again, you've got the party wall, common wall between them, and you've got the auxiliary off of the main, or you might have a granny flat in the backyard, for example. Dual keys, we don't see quite as much of it anymore. The apartments next door to each other, one on top of the other, they still do exist. They're still in the market. We can still find those, but they are a little harder to find in the current sort of market. Small commercial, probably more referring to the co-working space. Multiple incomes from the one property is the goal here. So when we look at cash is no longer king. Everyone used to say cash is king. I think cash flow is king. When you consider that cash sitting in the bank is going to go backwards, it's going to erode in value over time. You're looking at cash flow, multiple sources of income coming in is a great strategy for you. So diversifying those tenancies, it lifts the returns. You're getting a better return, and you're also spreading out the risk. So we're not asking you to go out and buy a multi-dwelling property and then have a lower rental income. It's actually a double-edged sword where you're getting the rental income is better and you're getting the risk sliced into smaller pieces as well. So that approach really does enhance your stability for your portfolio, and it does reduce what we call vacancy fatigue. Vacancy fatigue essentially is a tenant moves out of my house and for 3 months I don't have a tenant. I'm going to be feeling a bit of a pinch there. So we want to avoid that. When we look at the traditional style house again, over here, we've got an investor's purchased a property for $800,000. That's a single tenant house. And now we're competing with 5 tenants over here, 2 different tenancies and a dual key, and up to 4, let's say, small commercial units there. Now, we're doing a dollar for dollar comparison. So 800,000 purchase price is going to get you $720 per week on that traditional house. The co-living, $1,000 a week, dual key, $850 per week, and up to $1,200 per week on the small storage units or commercial facilities here. Now, what that means is more cash flow in your pocket, potentially more depreciation, more tax benefits as well. It has a lot of upside to, outlaying the same capital more sensibly, more rental bases, less reliance on a single tenant certainly helps And I think that's a great strategy. But with any purchase, always need to consider you do want to be buying as close to the bottom of the cycle as possible, because that's when the rents will start to go up. See a rising market, prices will increase, but do not enter the market, try to buy into the market at the approaching peak of market or the peak of the market here, because all you'll be doing is, this whole cycle, 7 to 10 years, let's call it, you're going to be sitting here for a very, very long time waiting for that growth to happen in those assets. So one of the things is investing into high yielding property, get the cash flow there, reduce debt, get yourself into a position where you can potentially buy another property. Now, the whole process, very straightforward, same as it would be for any traditional standard residential property as well. We take your expression of interest on a property that you see and you like. That property is held for you. We get your file set up, including getting IDs, contracts are issued in the correct name, collect any deposits, solicitors go through the contracts. Once you're happy, sign everything, move forward to any finance clause or due diligence period in the contract, and then you move to unconditional. And through the whole process, we're there to guide you and keep you on track. And if there's any escalations required, we manage that for you as well. So right now, just like to talk about the game plan. If you don't have a strategy or your structure worked out for how to build your portfolio and how to plan sensibly for the future, you need to understand first, what is the goal? When are you retiring? How much do you need? What income do you need? How much do you need to generate that income? Where are you at the moment? What's the gap? We then have to apply inflation to that whole scenario. And then we look at the other figures, which are quite confronting, but you have to know them, which is the total amount of interest you're going to pay to the bank, and also the tax liability between now and retirement. So you're probably paying a couple $100,000 in tax and a couple $100,000 in interest to the bank as well. And that adds up very, very quickly. So if you don't have a game plan, you want to get your strategy, get your structure sorted, please do feel free to reach out to us. As always, if you liked what you saw, feel free to connect with us on either social media, or you can just connect with us via email, drop us a text, whatever you need, and we'll take it from there. Thanks, guys.